Hello dear algorithms traders. In today's post we will talk about how we can protect ourselves from possible losses in the event of a black swan. Unexpected and improbable events with a significant impact are referred to in economics as black swans. There have been massive price losses on the stock exchange in recent years, which have driven many traders to ruin. Of course, such black swan events cannot be predicted, and that is exactly why it is important to achieve the highest possible level of security in order to be optimally protected in the worst case. There are a few ways to do that, which we'll cover in this video. Let's start by analyzing how such black swans come about. On September 6, 2011, the Swiss National Bank set a minimum exchange rate of 1.2 Swiss francs per euro. The background was that the Swiss franc had reached a massive overvaluation and thus increased the risk of a deflationary development. With the minimum exchange rate of 1.2 Swiss francs, the National Bank was aiming for a significant and lasting weakening of the Swiss franc. This announced that the National Bank wanted to enforce the minimum exchange rate with all the consequences. Half a year later, the euro fell below the minimum exchange rate of 1.20 Swiss francs and was immediately stabilized. From April to September 2012, we can clearly see that the course was repeatedly rejected upwards. At the end of September, massive buy orders came into the market, which then drove the price up sharply. In the 2 years that followed, the Swiss franc weakened more and finally reached the minimum exchange rate zone of 1.2 again in December 2015. Due to the announcement by the Swiss National Bank on December 6, 2011, most traders assumed stabilization again. It was precisely in this situation that most market participants were in a long position. On January 5, 2015, the Swiss National Bank announced that the overvaluation of the franc had decreased overall since the minimum exchange rate was introduced and that the minimum exchange rate of 1.20 was therefore being abolished. A short time later there was a massive drop in price by a total of 2,200 pips or 4,400 ticks. Here we see the price break out to the downside and run down 2,200 pips. Then price bounces back up, runs down a second time, and is then pushed up and down again and again. Now let's look at how these movements came about. First of all, we know that on January 15, 2015 most market participants were in a long position. After the Swiss National Bank abolished the minimum exchange rate of 1.2 Swiss francs, there were now some market participants who brought short positions into the market in the form of market sell orders. These short positions now hit the first stops of the long traders and now a massive chain reaction ensued. The downside accelerated, triggering more and more stops from long traders. The lower the price went, the fewer limit buy orders there were. Here we see the first short positions entering the market and triggering more and more stops. In principle, these stops were like an avalanche that kept rolling downwards. After all of the long traders were stopped out, no more market sell orders came into the market and the price was held up by a few limit buy orders. There were a few orders on the limit sell page that now determined the best ask price. Just one market buy order of one lot could move the price up 1,700 pips. However, that also cost a spread of 10,000 euros. When the price finally ran down again, you could reach a minus of over 20,000 euros with this position. Eventually, more and more limit sell orders came into the market and the best ask price approached the best bid price. As a result, the spread narrowed again and normalized. This means that this massive move lower was not triggered by a massive buying of the franc but by the selling of the euro triggered by the long traders' stops. Why didn't the long traders' stops work in this situation? To exit a long position, you need a buyer, in this case a limit buy order. But the lower the price went, the fewer limit buy orders were in the market. However, these limit buy orders were important in order to get the long trader out of the position. However, since there were fewer and fewer limit buy orders on the downside, the price had to keep going down until it reached the next limit buy order in order to close a long position. This resulted in massive losses. At the same moment, there were also some short traders who, despite trading in the right direction, did not receive their book profits. For one, the price was swinging back and forth in a huge volatility and there was no way to get out of the position in this situation. In addition, the market was suspended by some brokers, which also made the later evidence more difficult. In this respect, this downward movement was a losing proposition for most market participants. On January 29, 2018, I drew attention to this strong resistance zone on my blog at Forex Factory and made a downside forecast. 3 months later, the price moved into this resistance zone and has been short ever since. With the help of my Bionic Candle, you can determine these zones very well. The Swiss National Bank cannot be blamed for the fall in the exchange rate, since it pointed out on September 6, 2011 that it could take further measures at any time. Since the situation in Switzerland had normalized, no further foreign exchange had to be bought. Other unpredictable price breakouts are the so-called overnight gaps, which can be very expensive under certain circumstances. At the end of April 2017, there was a 188 pip gap in Eurist. Overall, it even took more than 3 years until this gap was closed again. At the beginning of the corona crisis, the price came into this gap. At this point, everyone was certain that the gap would now be closed. The big players sold their positions to the retailers without further ado, pushing the price up, and when everyone believed that the price would continue to rise, the gap was calmly closed and then the price continued to rise. At the end of February 2022, there was a bearish gap of 135 pips. Look, the price has gone up nicely and it looks like the gap is closing. In the end, most of them bet on the wrong horse again. The question now is, how can we protect ourselves from a possible black swan in the future? One option that could be considered would be not to trade, but of course that is not an option for a real trader. A trader in the Forex market enjoys the greatest protection, as he is legally liable at most with his account balance. As we know, future traders are also to be equipped with this protection in the future, although I can imagine that the costs will then be significantly more expensive than in the Forex market. Nevertheless, the risk in the futures market is significantly higher in the future, since I have to trade at least 0.1 lot, which increases my losses tenfold compared to the Forex market. If you get a professional status in the futures market to trade with a higher leverage, you automatically have the full risk again. As a professional Forex trader, I can even work with double leverage and only risk my account balance in the event of a loss. In this respect, the Forex market continues to win in all areas. Next, I recommend trading in assets that are less sensitive to global economic factors. Let's take a look at the Eurist. Here we see the stock market crash of October 19, 1987. We don't notice anything in the Eurist. September 11, 2011 created higher volatility, but no bigger candles than in the past. The stock market crash of January 21, 2008 could not be identified here. The corona crisis also had little impact on the Eurist. Of course, the past is no guarantee for the future. The fact is that there is massive liquidity in Eurist. And the higher the liquidity in an asset, the greater the security at the same time. Of course, with higher volatility you get into profit quicker, but since over 90% of participants are losing means that 90% of participants lose their money faster. I once took the trouble and analyzed 200,000 H1 candles in Eurist. On average, each H1 candle reaches 20 pips. The largest H1 candles are 350 pips. For comparison, in Euro Swiss francs, the black swan was 2,200 pip. In total, there were only 200 H1 candles that were larger than 100 pips during this period. That's only every 1,000th candle. In this respect, there has not been a clearly detectable black swan since the Eurist came into existence. But even that is no guarantee for the future. Since extreme black swans tend to fall off sharply, going forward one might only do short trades to protect against them. That wouldn't be completely stupid, since on average a downward movement is even 32 to 39% faster than an upward movement. That means less risk, because I can get out of the market faster, sometimes even have lower costs and make more profit overall. Additionally, I believe that protection is significantly greater in typical flat markets than in typical up markets. A trader can achieve significant advantages with my Bionic Candle, especially in sideways markets. You can find information about this in my numerous videos. Another consideration would be to trade off peak trading hours, as most black swan events have occurred within peak trading hours. However, that would not make sense due to many factors. With all these different perspectives, one inevitably wonders how the broker protects himself from it. First of all, the brokers have various options to protect themselves directly or indirectly against unexpected price developments. You can use your own strategies, such as hedging, or use the liquidity providers to reduce your risk positions. For example, if the Euro-US dollar is 40% short traders and 60% long traders, the broker would need to hedge a 20% short position through a liquidity provider to be out of risk. Hedging is not worthwhile for us traders, since we would only have double the costs with the high brokerage fees. In conclusion, let us state once again, from my point of view, a renunciation of trade or trading outside of the main trading hours does not make sense. The best protection against a black swan are therefore the following 4 points: trading in the forex market and in sideways markets. In addition, I would recommend more short positions than long positions and at the same time switch to markets with strong liquidity, for example Eurist. Fear is generally a very bad advisor in trading. However, being afraid is not a bad thing, it is just nature's way of surviving. However, fear paralyzes many traders and as a result, they miss many opportunities. I myself am not afraid of losing money, because the maximum I can lose is my account balance. And I've adjusted to that and I accept it. But I know for sure in case of a black swan I won't be in the red because I made the right decisions for myself. And that's exactly what makes me free from fear, so that I can calmly pursue my strategies. Perhaps you too will be able to free yourself from this fear in the future, because this is exactly what gives you enormous power and freedom, which you can use in trading. I keep my fingers crossed for you and wish you every success. Best regards, Michael.